Let's bring in Malcolm Ethridge now of Capital Area Planning Group and Shannon Sakosha of NB Private Wealth, both CNBC contributors. Malcolm, you first, because you do hold Apple. What do you make of these reports? And the question that I asked Steve Kovac, at what point do you say, as an investor, you know what, maybe this is just going to be different than I thought?
Yeah, Scott, I've been making the case to you for a while that Apple has to do something to justify this run-up that's happened. You know, all the questions about is it overvalued? When will they finally deliver? I think that realistically, this quarter report that's coming isn't going to do anything to help Apple out in that regard. I think that we're probably going to see a sell-off in those shares either leading up to or right after that earnings report, because nothing meaningful has happened to convince the world that Apple Intelligence is really going to be the game changer that we're all hoping it's going to be. But I'll also say that it is very important in the first half of this year that Apple does actually come out and show us how meaningfully important Apple Intelligence is to the ecosystem, simply because we need that as a read on how much demand there is from the consumer side for these AI tools that these companies have invested so heavily in, because up to this point, all of the developments have been on the enterprise side.
Shan, rough week for the NASDAQ, to say the least, made worse today, obviously, by the rise in rates. What do you make of that?
Well, I think it's two parts, Scott. I think coming off of, really kind of a run to the finish, if you will, for some of these stocks. And so, I think there has been some risk mitigation going on. I think there's some pairing of positions. If you think about for taxable investors, there obviously have some concentration in these names, even in and outside of what they might own through an S&P 500 conduit. The other thing is that we're in a scenario where we are getting a little bit fearful about rising rates, and there's a number. It's a multifaceted rationale for why rates have risen the way they have, and it's really on the foundation of economic growth. And so, if you're anticipating that there will be continued economic growth, if you're looking at an environment where you're higher for longer, and you're looking at the lofty valuations for some of these names, there is some of that vulnerability. And again, it's not just that we're concerned about kind of relative to other stocks in the S&P 500, earnings are still going to likely be stronger, but there is that deceleration. And so then you start to hit that inflection point where you look at your portfolio, you want to maybe trim some of those names, and you're a little bit concerned that earnings growth is not going to be quite as robust to justify these valuations with the headwind of higher rates into the middle of the year.
I know, Shan, but why doesn't good news just rule the day? I mean, at the end of the day, I think you hit it on the head. I mean, the fact that if you have a stronger economy, earnings are likely to be better. There still is, I don't know, the narrative doesn't seem to have changed really over the optimism about an incoming administration that's going to have tax cuts and deregulation and just an overall better feeling about where maybe things can go from here. Sure, it's a momentary upset, it feels like, because of the direction of interest rates and what it might mean for the Fed and what it won't do.
Well, equity investors, Scott, they're always looking for everything to be a tailwind, right? They're looking for the tailwind of economic growth and deregulation, M&A activity pickup, and lower rates and lower inflation. So, I mean, I think for us, when we look at the year, we're really constructive on equities still. But we acknowledge that this first quarter in particular might be choppy. So taking advantage of perhaps some of this fear of the uncertainty, post-inauguration and some of the executive orders that might be put into place, I think, again, you hit the nail on the head. Good news can be good news, but right now, in looking at the valuations and looking at kind of repositioning of portfolios coming off of really two really strong market years, I think that's why you're seeing a bit of this skittishness starting the year.
Malcolm, you're not changing your overall view of the market here, are you, as a result of the move in yields?
Not changing my overall view of the market, but I am changing my overall view of what will probably be the leading sector by the end of this year, right? So big tech has done very well by me and everyone else who's been in the markets the last couple of years, like Shannon said. But I think that realistically, investors that are expecting to simply rinse and repeat the same playbook, just buy the same 5 to 10 mega cap tech names that have done really well before, I think folks following that same playbook this year are setting themselves up for disappointment. I think realistically, there are a number of headwinds, as you just mentioned, that investors are focused on. But the biggest one for tech investors is simply that the comparables for the last year and, frankly, the last 2 years that any expectation of earnings would be based on are just way too hard to hit at this point, at the same time that tech investors' expectations have already been out of control and they continue to grow out of control while we're seeing valuations reach these questionable points. And so I just don't think that it bodes well for anybody who's looking to simply put the money back where it came from at any sell-off. I think that realistically we have to look for opportunities within tech specifically, but then also look at which other sectors will do more favorably under the incoming administration.
Well, I mean, you're thinking about that and being actionable as a result, right? I mean, at least as it relates to financials. I know you added that recently for your clients.
Yeah, so we added the XLF to many of our client portfolios. I wholeheartedly expect for the number of tailwinds at the back of financials, specifically the larger G-SIBs, right? So if we think about potential tax cuts at the corporate level, if we think about decreasing interest rates throughout 2025, whether it's 2 cuts or 3, if we think about additional deal flow coming in the form of IPOs and other M&A activity, that all spells a heads they win, tails they win kind of scenario for those financial names. And so we've added that as the sector that we anticipate will do meaningfully well regardless of what direction the rest of the market decides to go.
Shan, you still believe in this broadening story that you've been telling us about, even in the face of higher rates? That seems to be a legitimate problem.
It's a legitimate concern. I wouldn't say it's a problem that can't be overcome. And I think that's because, again, in addition to our broadening out theme, Scott, in terms of, this earnings deceleration for the names that have done really well, we're also looking at the potential for above-trend economic growth this year, which is part of the foundation of our story. We also expect there to be growth in real disposable income, and we expect small businesses to be able to have an environment in which they can focus on growth. And so it's not just in the public space, it's in the private space. This broadening out, we think there is a foundation. Higher rates were certainly one of the tailwinds lower rates, were one of the tailwinds we would have liked to see. And we will see lower rates, maybe not as low as we thought. But we think that they will be offset by this economic momentum that we're talking about. And again, that is really at the foundation of our thesis for the broadening out in 25.